This week, 4 of the biggest companies in the world reported earnings. All 4 beat expectations. 2 of them went up. 2 of them went down hard. Microsoft rose 15.5%. Amazon rose 15%. Meta fell 8%. Apple fell 8% on its best June quarter in company history. Same week, same market, same kind of result. Opposite outcomes. If beating earnings isn't what decides it, what does? Last Saturday, we looked at why Alphabet posted record profits and fell 7%. The answer was free cash flow. The company was earning more and keeping less because it was spending enormous sums on data centers. This week, that same idea came back, but with a twist that explains a lot more than capital spending does. Start with something simple. A stock price is not a judgment about this quarter. It is the market's estimate of every dollar the company will ever earn, added up, and then discounted back to what those future dollars are worth today. That second part is the one almost nobody thinks about, and this week it was the only part that mattered. Here's why future dollars are worth less. If you can earn 5% risk-free by lending money to the US government for 30 years, then a dollar you receive in 30 years is worth far less to you today than a dollar in your hand. That comparison rate is called the discount rate, and the 30-year Treasury yield is the closest thing the market has to it. On Friday, the 30-year Treasury yield closed at 5.25%. That is the highest it has been since 2007, 19 years. Most investors in the market today have never traded a full cycle at this level. That single number quietly repriced everything else this week. Now here's the part that explains the split. When the discount rate rises, it does not hurt every company equally. If most of your profit arrives this year, a higher discount rate barely touches you. If most of your profit is a promise about 2030, the same move takes a large bite out of what that promise is worth today. Mere earnings survive. Far earnings shrink. Test that against the week. Microsoft reported Azure growing 43% and said Azure revenue had passed $100 billion for the first time. That is not a promise about the future. That is cash arriving now, at scale, at a 39% margin. The stock rose 15.5%, reportedly its largest single-day value gain ever. Amazon is the interesting one because Amazon spent more. Capital spending over the last 12 months hit $169 billion, up 64%. Free cash flow swung from an $18 billion inflow to a $7.6 billion outflow. Amazon also guided next quarter below what analysts expected. On paper, that is the profile of a stock that gets punished. It rose 15%. Amazon rose because it showed the demand was already contracted. A $496 billion backlog, AWS growing 37%, its fastest in 18 quarters. And it explained the weak guidance precisely, pointing at Prime Day timing rather than leaving it vague. The spending was still a promise, but the revenue behind it was not. Meta did the opposite. It raised its 2026 capital spending target to between $130 and $145 billion and raised its expense guidance too. Revenue beat. But the market was not shown a backlog, or a business unit already earning that money back. Just a larger bill, arriving sooner, with the payoff pushed further out. The stock fell about 8%. And then Apple. Revenue of $109.4 billion ahead of expectations. Earnings of $2.02. iPhone revenue up 22%, the best June quarter in the company's history, and the stock fell about 8%. Apple has no capital spending problem, so if the theory only explains capital spending, it fails right here. What Apple actually did was guide next quarter to 9 to 11% revenue growth against about 12% expected and give one reason: supply constraints. That is a sentence about the future with no way to check it. And in a 5% discount rate environment, an unverifiable claim about future revenue is exactly the thing that gets marked down. The market was not punishing spending, it was punishing uncertainty. So here is the pattern for the week. Amazon guided below expectations and rose because it explained the gap and proved the demand. Apple guided below expectations and fell because it did not. The rate environment set the price of a promise. What each company could prove decided whether they paid it. Now let me argue against myself, because one clean idea explaining a whole week should always make you suspicious. Apple also reported weak services revenue and it fell on China concerns. Both are company-specific and have nothing to do with interest rates. Meta's earnings miss included a $2.4 billion legal charge. Amazon's headline earnings number was inflated by a $53.4 billion gain on its stake in Anthropic, which is not operating profit at all. So the discount rate is not the whole story. It is the reason all four reactions were sharper than the news alone justified. Think of it as the market's sensitivity dial. At 2% yields, a vague sentence about next quarter is forgivable. At 5.25, it is expensive. Same sentence, different price. And this does not stop at the American border. The US 30-year is the reference rate the rest of the world is priced against. When it rises, dollars get pulled home, emerging market currencies come under pressure, and Indian IT companies that earn in dollars and report in rupees feel it from both directions at once. If you hold assets in two countries, this is one number that touches both. 3 things worth watching. First, next week's jobs report. The first read since 3 Fed officials broke ranks and voted for a rate hike. Second, whether the 30-year holds above 5.2 or breaks higher. And third, whether any company that guides softly gets forgiven. That is the real test of whether this week was a pattern or a coincidence. The lesson isn't that Apple is in trouble or that Amazon is safe. It's that the same result can be read 2 completely different ways depending on what the risk-free rate happens to be that week. Beating earnings was never the bar. The bar moves, and right now it is sitting at 5.25%. I'm going to keep tracking this one. Subscribe, and I'll see you Monday for the close.